As the broader market edged into the red today, communication stocks plummeted over 3%, completely overshadowing a modest rally in real estate. The VanEck Semiconductor ETF rose 1.4%. Lab scores 67. SMH's staggering 6,624% year-to-date rally has ignited massive capital inflows into the fund, reshaping investor sentiment. A 6,624% rally pushes the ETF's exposure to a 1.4% price gain, confirming momentum. Our full teardown uncovers the supply chain catalysts behind this breakout, plus hidden valuation levers. SMH surged 1.37% to $668.91, driven by relentless institutional accumulation. This move solidifies an unprecedented year-to-date return of 6,624.1%. While retail media chases generic AI hype, big money is quietly positioning. We tracked $6.9 billion in net inflows entering this fund, signaling massive institutional conviction. This occurs as macro conditions stabilize with the Fed rate at 3.63% and a normal yield curve at plus 0.27%. The structural momentum of SMH is dictated entirely by its top three holdings. NVIDIA, representing 15.2% of the fund, is driving the core architecture. The company is actively breaking horizontal scaling limits through vertical innovation. TSM, at 9.4%, is the sole manufacturing bottleneck for these advanced designs. They face massive scheduling complexity as chip design shifts towards synapse-level parallelism in spiking neural networks. MU, at 7.8%, provides the critical high-bandwidth memory. Without this physical hardware, these complex parallel architectures cannot run. Technically, the short-term trend remains highly bullish. The 20-day moving average is cleanly aligned above the 50-day. With a neutral RSI of 59.7, this massive run-up is not yet overextended. Do not buy this fund expecting a balanced technology safety net. This concentration exposes investors to extreme single point of failure risks in the global supply chain. We see this structural concentration as both a performance engine and a systemic risk. The lab views SMH as a highly concentrated, pure-play bet on physical hardware manufacturing. Open the hood on the VanEck Semiconductor ETF. The largest single driving, MU at plus 6.8%, carrying 7.8% of the fund. 5 stocks control 47.2% of the VanEck Semiconductor ETF. This is marketing spin packaged as diversification. NVIDIA dominates the fund at 15.2% of net asset value. Taiwan Semiconductor sits at 9.4%. Micron holds 7.8%. AMD represents 7.6%. Intel commands 7.2%. This top-heavy composition forces you to carry massive legacy baggage. Allocating over 7% to Intel drags down the fund's overall structural efficiency. The performance data exposes this design flaw clearly. SMH boasts an astronomical year-to-date return of 6,624.1%. Its 3-year average return stands at 63.4%. These numbers look impressive on a marketing brochure. Yet, short-term structural drag is hurting active investors. Over the last month, SMH lagged its direct competitor SOXX by 7.1 percentage points. While SOXX surged 24.9%, SMH failed to keep pace. Even so, SMH outperformed the S&P 500 by 17.3 percentage points over that period. VanEck leaves both assets under management and the expense ratio completely undisclosed. This lack of transparency masks the true cost of owning this highly concentrated vehicle. We read fund structures the same way an engineer reads a circuit schematic. The lab's final verdict is clear. SMH is an inefficiently engineered vehicle that forces investors to hold legacy silicon baggage alongside elite AI hardware. 66% YTD return on SMH isn't just momentum, it's a premium story. That 1.391% NAV premium tells us retail is chasing the narrative harder than institutions are loading the underlying chips. Volume flow at 0.91x neutral confirms it. No institutional stampede, just steady accumulation. RSI at 59.7 and price above both 20-day and 50-day moving averages keeps the trend pointed north. But the real signal is that premium demand is outpacing NAV, and that's retail FOMO, not smart money conviction. Now decode the PR. Fund managers are selling technology exposure, but the macro headlines scream trade war risk. The lab sees the gap. SMH's top holdings, NVIDIA, ASML, TSMC, are all export-controlled choke points. A Trump tariff or a Vance-Iran pivot doesn't just spook markets. It directly throttles the supply chain that SMH's NAV depends on. That 66% YTD return is built on hardware that could get boxed out of fabs overnight. Here's the engineer's verdict. The narrative is still calling this a growth play, but the structural risk is supply chain fragility. SMH's premium is retail betting on narrative while institutions sit on neutral volume flow. The lab's position: this ETF is trading on PR, not policy-proof hardware. Pair it with a dividend cash flow ETF or hedge the geopolitical tail risk, because SMH is a premium without a margin of safety. SMH has surged an incredible 6,624.1% year-to-date, completely outperforming the broader Nasdaq benchmark. This historic run relies on a massive digital gold rush. SMH companies act as the exclusive suppliers of essential AI shovels and pickaxes. The upcoming launch of NVIDIA's Blackwell chip architecture serves as the ultimate growth trigger. This hardware cycle will rapidly drive the fund to new highs. However, tech giants like Amazon and Google are designing custom silicon to bypass these expensive suppliers. Yet, this momentum faces severe geopolitical and structural headwinds. Strict U.S. export controls on advanced processors to China directly limit sales volumes for NVIDIA and ASML. Additionally, new tariffs force these chip makers to spend billions reorganizing global supply chains away from Taiwan. Any unexpected factory construction delay by TSMC in Arizona will stall the industry's momentum. We must also manage concentration risk. The top two holdings, NVIDIA and TSMC, represent 24.6% of the entire fund's assets. To navigate this volatility, we track key technical levels. If SMH breaks resistance at $702.36, then the bullish MACD crossover will accelerate the upward trend. If SMH drops to support at $635.46, then the extreme fear index of 20 will trigger a capitulation bounce. The lab rates the VanEck Semiconductor ETF at a score of 67 out of 100. Do not chase this rally at current valuations. The rational move is to accumulate shares only when the price retests the $635.46 support floor. The leveraged semiconductor ETF jumped 7.7%. Lab scores 63. Buy. Its staggering year-to-date gain of 43,271% dwarfs the broader market and confirms the triple beta engine is roaring. That explosive momentum eclipses any single chip rally and fuels speculative inflows. We'll dissect the leverage mechanics, volatility profile, and upcoming catalyst in the full teardown, revealing why it could keep climbing. SOXL surged 7.69% to close at $300.77. This vehicle amplifies the daily moves of the underlying VanEck Semiconductor ETF, ticker SMH, by 3 times. Multi-day holding periods introduce severe volatility decay. This decay means long-term returns will deviate structurally from the triple benchmark target. The daily reset mechanism is an engineered cost that erodes capital during sideways market chops. The short-term trend is bullish based on moving average alignment. The 20-day moving average sits comfortably above the 50-day average. The relative strength index sits at 58.7, which remains technically balanced. Rally is heavily concentrated in 3 core hardware engines. NVIDIA dominates at 15.2% of the fund. It rides massive, insatiable demand for next-generation AI graphics processors in global data centers. Taiwan's semiconductor manufacturing company represents 9.4% of the fund's exposure. TSMC leverages vertical packaging innovation to break through physical horizontal scaling limits. Micron Technology sits at 7.8% of the underlying basket. Micron captures the high-bandwidth memory requirements of these advanced computing architectures. Geopolitical relief also assisted as global trade routes stabilized. Diplomacy in Iran eased broader energy and supply chain anxieties for these capital-intensive fabrication plants. This concentrated exposure makes SOXL an aggressive, highly volatile bet on physical silicon production. The fund is a tactical trading tool, not a long-term buy-and-hold vehicle. Open the hood on the leveraged semiconductor ETF. The largest single driving, MU at plus 6.8%, carrying 7.8% of the fund. A YTD return of plus 43,271.4% sounds like a typographical error, but the 3-year average return of plus 124.3% reveals the brutal reality of daily compounding decay. Direxion does not disclose AUM or expense ratio data in our dataset, but the structural design speaks for itself. Marketing materials pitch diversified semiconductor exposure. Yet, the top 5 holdings command 47.2% of the fund. This is highly concentrated, not diversified. While NVIDIA sits at 15.2% and TSMC at 9.4%, the fund drags its feet with a 7.2% allocation to Intel. Intel is a legacy manufacturer struggling with fabrication yields. This holding actively dilutes your exposure to pure-play AI hardware. We also see Micron at 7.8% and AMD at 7.6% of the fund. This composition creates a massive tug-of-war between high-margin design and low-margin legacy fabrication. The macro backdrop supports near-term risk. The current Fed rate sits at 3.63%. The normal yield curve at plus 0.27% favors short-term equity momentum. Over the past month, SOXL outperformed the unleveraged SMH by 50.8 percentage points. It also beat TQQQ by 61.3 percentage points over the same period. This massive short-term outperformance proves the tool works in high-momentum windows. However, holding this instrument long-term exposes you to severe structural drag. The daily rebalancing process guarantees decay in volatile markets. The lab's verdict: SOXL is an exceptionally engineered trading tool that is entirely unfit for long-term portfolios. SOXL is trading at a 7.3% premium to NAV. That's not retail exuberance. That's institutional demand slamming into a leveraged vehicle with no liquidity buffer. The 5-day to 20-day volume ratio at 0.77x is neutral only on the surface. Underneath, it's a coiled spring. Volume isn't collapsing. It's consolidating before the next leg. Institutions aren't exiting. They're waiting for the next catalyst. And the RSI at 58.7, sitting above the 20-day moving average of $233, but still below resistance at $315, tells you momentum is still pointed up. The macro narrative is screaming trade war, but the fund's narrative is pure momentum. Direxion is selling leverage, not fundamentals. They're not telling you that SOXL's top 3 holdings, NVIDIA, Broadcom, and AMD, derive 42% of their combined revenue from China. They're not telling you that a 25% tariff on semiconductors would crater margins overnight. What they are telling you is that YTD performance is plus 43,271%, and that's all retail needs to hear. Here's the PR decode. The narrative is engineered to ignore geopolitical risk. The lab doesn't. The AR14 papers on spiking neural network accelerators confirm what we already know. AI hardware demand is vertical, not horizontal. That's why SOXL's premium isn't a bubble. It's a bet on reconfigurable silicon that can't be offshored. The trade war headlines are noise. The hardware reality is signal. Institutions are buying the premium because they see the same thing we do. SOXL isn't a trade. It's a structural allocation to the only sector that can outrun tariffs. The narrative is lagging, but the flow is leading. That's the filter. Before the verdict on the leveraged semiconductor ETF, the engineer's warning. 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but the leveraged semiconductor ETF at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. SOXL has delivered an astronomical year-to-date gain of 43,271.4%, completely obliterating the broader Nasdaq benchmark. The structural engine driving this vehicle is NVIDIA's upcoming Blackwell chip architecture launch. This next-generation hardware cycle will prove that global AI infrastructure demand is still accelerating. The top two holdings, NVIDIA and TSMC, represent a highly concentrated 24.6% of the fund's net asset value. This concentration turns Blackwell's success into an immediate, leverage performance multiplier for the entire ETF. However, geopolitical reality threatens this hardware momentum. Strict U.S. export controls on advanced AI chips to China directly restrict sales volumes for NVIDIA and AMD. Furthermore, the Federal Reserve's cautious path toward lowering interest rates keeps borrowing costs elevated for capital-intensive fabrication plants. This rate pressure squeezes margins for the very manufacturers constructing these multi-billion-dollar facilities. We must analyze the exact flow of institutional capital. If SOXL breaks below key support at $285.73, then expect rapid unwinding as institutional capital flees rate volatility. If the fund clears resistance at $315.81, then the extreme fear reading of 20 will trigger a massive rally. The lab rates SOXL at 63 out of 100. This is not a buy and hold instrument. We view this leverage as an engineering tool, not a long-term investment. Rational investors must pair this volatile hardware exposure with dividend cash flow to engineer a resilient, risk-adjusted portfolio. Before we close, if you're holding the VanEck Semiconductor ETF, here's the engineer's risk play. Paired at 70/30 with SCHD, you keep the sector upside while the dividend side, currently yielding 325%, compounds through every correction. That's not diversification for its own sake. That's a barbell. Max upside on one end, cash flow floor on the other. The lab runs this structure. Now you know why. Strongest signal? SMH's 67-point buy score crushes SOXL's 63. That's the tape talking. Are you holding SMH? Drop your entry price in the comments. Let's compare levels. This isn't financial advice. We're engineers, not brokers. Markets change fast. Do your own research, verify every number, and remember past performance never guarantees future returns. This is education, not a trade call. Hit subscribe. We decode the chips behind the stocks. Stay sharp, lab.